Welcome back, fellow financial analysts. Today, we are putting Cactus, ticker WHD, through the absolute ultimate gauntlet, Warren Buffett's strict value investing framework. We're going to combine a qualitative moat assessment with some truly rigorous quantitative valuation to build a complete bulletproof investment thesis. And we're doing this using only the hard data from their recent financial filings and analyst reports. By the end of this explainer, we'll know for sure if this energy services company is a wonderful business trading at a fair price. Let's get right into it.
Here's our roadmap for the analysis. We've got 5 quick steps: business and moat, financial analysis, valuation models, margin of safety, and finally, our verdict.
Kicking things off with Section 1, Business and Moat, the Buffett way.
Okay, first things first. What exactly does Cactus do? You know the golden rule, right? You literally cannot value a business if you don't fully understand how it makes its cash. At its core, Cactus provides highly specialized wellhead equipment. They basically operate in 2 main segments: pressure control and spoolable technologies, primarily serving unconventional onshore oil and gas producers. And this is key. They recently expanded their global footprint in a big way by closing an acquisition of a majority interest in Baker Hughes' surface pressure control business, which is now called Cactus International.
Now, here's where we hit a bit of built-in friction. Do they actually have an economic note? Well, we're rating it as narrow. They definitely possess a distinct product niche and a phenomenal brand reputation with their Cactus Wellhead and Flex Steel brands. But the notorious brutal volatility of the oil and gas market, which creates these massive swings in U.S. land drilling activity, really forces us to cap their competitive advantage. At the end of the day, they're price takers in a highly cyclical macro environment.
Let's run them right through the Oracle's qualitative checklist. Is it an understandable business? Yes. Is the advantage durable? Narrowly, yes. But again, cyclical. Do they generate consistently high returns on equity? Absolutely. They posted a stellar 19.1% ROE in 2024. And finally, do they have able and honest management? Guys, this is a massive green light. Management has a highly shareholder-friendly capital allocation track record, and they own an impressive 17% of the company. That means their interests are totally aligned with ours. Real skin in the game. So heading into our valuation, their baseline is actually looking pretty solid. Backed by the sure dividend data, we're looking at a $52 current stock price, a $4.2 billion market cap, and a 1.1% dividend yield. It's a very strong foundation anchored by that owner-operator management team we just talked about.
Moving right along to Section 2, Deep Financial Statement Analysis.
Let's dive into the hard data and see if the financial statements actually back up that quality management narrative. Looking at the historical income statement trends, you can really see the sheer force of that industry's cyclicality I mentioned. I mean, look at 2020. There was a severe earnings plunge during the pandemic where EPS just plummeted by 62%. But check out the recovery. By 2024, revenue rebounded robustly to over $1.1 billion, and they posted incredibly strong net margins of 16.4%, generating $277 million in free cash flow.
But we really need to look closely at this snapshot from Q1 2026. Total revenue absolutely skyrocketed to $388.3 million, with pressure control jumping to $302 million, all thanks to that Cactus International acquisition. But notice how GAAP operating margins temporarily compressed down to 12.7%? Why did that happen? Well, it's strictly due to purchase price accounting items, specifically $19 million in inventory step-up and intangible amortization expenses. If you look at their adjusted EBITDA margins, they actually remain super healthy at 25.8%.
Okay, now here's a number that would make Warren Buffett literally sit up in his chair. Look at this balance sheet strength. As of Q1 2026, Cactus holds over $291 million in cash with absolutely zero bank debt. Zero. In a highly volatile, capital-intensive sector, having a pristine, unlevered balance sheet like this grants them massive survival power through industry downturns.
All right, on to Section 3, Quantitative Valuation Models.
With a solid grasp of that beautiful debt-free balance sheet, it's time to crunch the numbers. Let's build our discounted cash flow model. Based on management's conservative outlook and historical averages, we are going to project a 5% average annual earnings growth over the next 5 years. For the terminal value, we'll use a standard 2% perpetual growth rate to align with long-term GDP. Now, since our source filings don't explicitly hand us the exact inputs for the weighted average cost of capital, we're doing what any rigorous analyst would do. We're explicitly assuming a conservative 10% cost of equity discount rate to account for the energy sector's inherent risk premium.
Let's cross-check that with Ben Graham's classic intrinsic value formula. We take the projected $3 EPS, multiply it by 8.5, plus 2 times our 5% growth rate, and then multiply all that by 4.4. Now again, we must strictly note our assumption of a 5% AA corporate bond yield for the denominator Y, since it's completely missing from the texts. Running that calculation gives us a fair intrinsic value of roughly $48.84 per share. For simplicity, let's just round that up to $49.
And if we cross-reference this by looking at relative multiples, we see some friction. Excluding those abnormal pandemic years, Cactus has historically traded at an average price-to-earnings multiple of 16.2. Today, it sits at 17.3. As a highly cyclical business, paying an above-average multiple during a period of healthy earnings is just a textbook recipe for multiple contraction risk.
So this creates severe relative valuation friction. Based on the historical sure dividend analysis, reverting back to that fair 16.2 multiple over the next 5 years would actually create a negative 1.3% annualized valuation drag on our total returns.
Which brings us to Section 4, Margin of Safety. This is the most critical concept in all of value investing, right? We need our safety net. We have a consensus intrinsic value of around $49 per share. But to protect our capital from the sudden, dramatic cyclicality of the energy services sector and those inevitable drops in U.S. land rig counts, we simply cannot pay fair value. We absolutely must demand a 25 to 30% discount from our intrinsic value estimate before we even think about initiating a position.
If we apply that strict 30% margin of safety to our $49 valuation, we get a target buy price of exactly $34.30. This means the current $52 stock price offers us absolutely zero downside protection. In fact, it's trading at a roughly 6% premium to our fair value estimate right out of the gate.
And looking at the broader cash flow metrics really confirms why we need this defensive stance. While free cash flow per share remains incredibly healthy at over $3 projected for the near future, paying a premium today leaves literally no room for error if, say, Middle East logistics disrupt further, or if domestic drilling activity slows down to preserve capital.
Finally, Section 5, the final Buffett-style verdict.
It is time to bring it all together for the committee. We need to synthesize our qualitative moat assessment with our quantitative valuation. The crucial point is this: Cactus is undeniably a high-quality business. It has a pristine, debt-free balance sheet, it's managed by heavily invested owner-operators, and it dominates its specific pressure control niche. It really is a wonderful business, but it is simply not available at a fair price right now. Therefore, our official verdict is to pass or hold if you currently own it.
So here is our official thesis summary for the Value Investment Committee. Keep Cactus exceptionally high on your watch list. We are just waiting for the next inevitable energy sector downturn to create some market panic. When that cyclical weakness drags this debt-free gem down toward our $34 margin of safety entry point, that's when we strike. Until then, ask yourself, would Warren Buffett ever overpay for a cyclical stock just because the balance sheet looks pretty?